Okay, let's dive in. We're looking today at something really fundamental for anyone watching the stock market.
Yeah, how those big government decisions and what the central bank does, the RBI here in India, how that all filters down to stock prices.
Exactly. And you brought some great material for this deep dive. It seems really helpful, especially if you're maybe newer to trading.
Right, it breaks down that connection policies, the market, quite clearly.
So our mission here is to sort of pull out the key stuff. We want you to finish this knowing which policies to watch, how they actually work, and really importantly, which parts of the market get affected most.
Yeah, so the next time there's a budget speech or the RBI changes rates, you'll have a better feel for what might happen.
We'll be hitting the two main areas this material talks about.
Yeah.
Government actions, budgets,
Yeah.
spending, taxes.
Fiscal policy, yeah. And then the RBI side, interest rates, money supply, monetary policy.
All right, let's start with the basics. When we say government policies here, what are we actually talking about?
Well, essentially, it's the rules, the regulations, the big actions the government takes that, shape the economy.
Any specific examples from the source?
Sure. Like changing the GST rate on something, say, bumping it up on cars from 28% to 30%, that's a policy.
Yeah.
Or, big spending plans, like
Yeah.
dedicating, 10 lakh crore just for building roads. That's a direct government policy decision.
Got it. And then the RBI policies.
Right. So that's the central bank. They're focused more on the financial side, managing credit, keeping inflation under control, the overall flow of money.
Which usually means things like setting that main interest rate, the repo rate.
Exactly, the repo rate. The material mentioned it being around 6.5% as an example, and also trying to manage inflation, maybe aiming for that 4% CPI target.
Okay, so why does all this stuff matter so much for stocks?
Well, the core idea here is that these policies really change the economic environment.
How so?
They influence company profits directly. They affect how much money people like you have to spend. And crucially, they shape investor confidence.
Ah, confidence.
Right.
Yeah, and those things, profits, spending, confidence, they're huge drivers for the stock market.
So it's not just abstract rules. They actually hit companies, hit consumers, and that shows up in the market.
Precisely. Think of them like powerful currents moving the market.
Okay, so let's talk about how they push things around. Can go either way, right? Good or bad for stocks.
Absolutely. They can lift the market or sink it. Starting with the government side, the big one is fiscal policy.
The budget stuff, spending and taxes.
Exactly. If the government rolls out a huge budget, say 50 lakh crore for the year, and earmarks a lot for infrastructure or maybe rural schemes.
Then companies in those areas benefit.
Right. More potential business usually means investors feel better about those companies pushing their stock prices up.
But they can also take things away, like through taxes.
Definitely. If they decide to increase the corporate tax rate, say, to 30%, well, that eats directly into a company's net profit.
And lower profits usually mean lower stock prices.
Almost always. We saw this, didn't we? The 2023 budget example was good.
Yeah, more railway spending, 2.4 lakh crore.
And IRCTC stock got a lift. But then higher tobacco taxes.
Hurt companies like ITC. Makes sense.
And it's not just taxes and spending. Regulations matter too.
How do they play in?
Well, new rules, maybe tougher environmental standards, or putting import duties on things like that 20% duty on electronics example.
That increases cost for businesses.
Exactly. Higher costs squeeze margins, and that can pull down stock prices for those industries.
Okay, let's switch from the government budget side to the RBI. Money and interest rates.
Yeah, and interest rates are a really, really big lever.
So when the RBI raises the repo rate, like that 6% to 6.5% example.
Right. That makes it more expensive for banks to borrow from the RBI.
And banks pass that cost on.
They do. Loans get more expensive for everyone, companies needing cash to expand, people wanting to buy a car. Maybe that 10 lakh car loan gets pricier.
So higher borrowing costs slow things down. Less borrowing, less spending.
That's the usual effect. It tends to cool down economic growth, cool down spending, and that puts downward pressure on stock prices generally.
And the opposite if they lower rates.
Right, the material points that out. Lower rates make borrowing cheaper, which can stimulate investment and spending, and that's usually good news for the market.
And the RBI also manages the money supply, right? How much cash is floating around.
Yeah, liquidity. If they're worried about inflation getting too high, they might tighten things, pull money out of the system.
Making it harder for businesses to get funds?
Harder and more expensive. Again, that can hurt growth, hurt stocks. If they loosen policy, add liquidity, it tends to encourage spending and investment, often lifts the market.
That 2022 example really showed this. Inflation was high, like 7%.
And the RBI jacked up rates from 4% way up to 6.5%.
And the Nifty index fell.
Yeah, it reacted negatively. Borrowing costs just shot up for companies, especially those relying on growth, like startups.
Beyond just the numbers, though, there's the sentiment factor.
Oh, definitely. Policy sends signals. They affect how optimistic or pessimistic investors feel about where the economy's headed.
So the market reacts to the mood.
Very much so. If a budget looks really pro-business, maybe tax cuts, less red tape investors think, okay, profits might go up.
And they buy stocks, pushing prices up, like the Sensex or Nifty.
Exactly. But flip side, uncertainty is bad news.
Like policy delays.
Yeah.
Or confusing signals.
Right. That makes investors nervous. They might sell stocks, sit on the sidelines, which can cause sell-offs.
So even just a hint of a rate hike could cause a dip.
It absolutely can. If the RBI signals they might raise rates soon because of inflation fears, you could see stocks fall just on that fear of slower growth coming down the line.
Which brings us to policy surprises. This is where it gets dramatic.
Yeah, this is where you can see really sharp, sudden moves. Unexpected policy changes often trigger strong reactions.
Like cutting subsidies unexpectedly.
Right. The example was a 50,000 crore fuel subsidy cut. If that happened out of the blue, energy stocks could just tank.
Yeah.
Because their profits would suddenly look much worse.
But a surprise rate cut could cause a rally.
For sure. If the market isn't expecting it, a sudden rate cut can send stocks soaring.
The material used the 2016 demonetization as a big surprise example.
Classic case. It reportedly hammered consumer stocks because the sudden cash shortage just stopped people spending for a while.
So the general rule here, the quick takeaway is,
Pro-growth policies, low rates, government spending, tax cuts tend to lift stocks. Restrictive policies, high rates, tough rules, tax hikes can hurt them.
but crucially, it's not the same impact everywhere.
Not at all. It really depends on the sector.
Okay, perfect transition.
Yeah.
Let's look at that now. The sector deep dive. When policies get restrictive, who really feels the pain and who's maybe a bit more insulated?
Right. So when the government or RBI tightens the screws, higher taxes, stricter rules, rising interest rates, some sectors are just much more exposed.
Why is that?
Usually because they depend heavily on borrowing or on people having extra cash to spend, or they thrive on less regulation.
So which ones tend to get hit hardest based on this material?
Consumer discretionary is usually right up there.
The non-essentials.
Exactly. Things people want but don't necessarily need. If GST on luxury goods goes up to 30%, or that 15 lakh car loan gets way more expensive because of rate hikes.
People just cut back on those purchases.
Right. Fewer cars, fewer holidays, fewer expensive watches. So companies like Maruti Suzuki, Titan, maybe Make My Trip, their sales drop, and their stocks often follow.
Real estate, too, you mentioned being sensitive.
Hugely sensitive, especially to interest rates. Think about home loans. If rates go up, say from 7% to 9% on a typical 50 lakh loan,
Monthly payments jump up.
significantly, and that just slams the brakes on home sales. Plus, tougher regulations or cutting tax breaks for homeowners also hurts developers like DLF or Oberoi Realty.
What about tech, particularly the growth-focused ones?
They can be quite vulnerable too. A lot of tech companies, especially the newer ones, need to borrow a lot for expansion, maybe that 100 crore for R&D or marketing.
Higher rates make that borrowing painful.
Very painful. Plus, things like stricter data rules can add costs. And, when policy tightens and the economy looks uncertain, investors often shy away from these growth stories. They prefer safer bets.
So companies like Zomato or Paytm could feel that pressure.
Right, that's the kind of profile. And then there's industrials and infrastructure.
Tied to government spending.
Heavily. And they also need loans for big projects. So if the government cuts back, maybe spends 5 lakh crore less on roads than expected, or if rising rates stall projects.
Their business slows down.
Exactly. Profits drop for companies like L&T or GMR Infra.
Okay, so those are the sectors that really feel the pinch. What about the ones that tend to hold up better? The more resilient ones?
Yeah, the defensive plays. These are typically sectors selling essentials, things people need regardless of the economy. Or they might even benefit from certain policies.
Consumer staples comes to mind.
Perfect example. People still need soap, basic food, toothpaste, even that 50 bar of soap example. Demand is pretty steady.
Even if prices go up a bit.
Yeah, often these companies can pass on cost increases because people need their products. Think Hindustan Unilever, Dabur, the staple side of ITC. Their business is just more stable.
Healthcare too. Makes sense.
Right, right. You don't stop needing medicine or hospital care just because interest rates went up. That 1,000 prescription still needs filling.
And sometimes government policy helps them.
Absolutely. Things like healthcare subsidies, schemes like Ayushman Bharat can actually boost demand for hospitals and pharma companies. So Cipla, Apollo Hospital, is often seen as defensive.
Okay. What about utilities?
Again, essentials. Electricity, water, gas, people need to keep the lights on. Paying that $5,000 monthly utility bill isn't really optional.
And they're often regulated.
Yeah, often their pricing is regulated, which adds another layer of stability. Companies like NTPC or Adani Power fall into this category.
Now, financials were mentioned as sometimes resilient. Why sometimes?
It's a bit mixed. On one hand, when the RBI raises interest rates, banks can often charge more for the loans they give out.
So their profit margins can increase, like getting an extra $10,000 interest on a 20 lakh loan.
Potentially, yes. That can be good for their bottom line. However, if those tight policies actually tip the economy into a bad slowdown or recession...
Loan defaults could rise.
Exactly, and that hurts banks badly. So they can benefit from rising rates initially, but a deep policy-induced downturn is still a risk. Usually the bigger, more established banks handle this better.
Like HDFC Bank or ICICI Bank.
Right, those types. So the quick summary from the material. Worst hit are often cyclicals, policy sensitives. Least affected are the defensives, stable demand sectors.
Okay, let's make this concrete. That 2022 real-world example you mentioned earlier really seems to pull it all together.
Yeah, it's a great illustration. So 2022, RBI aggressively hiking rates from 4% to 6.5% to fight that 7% inflation. And the government tightened rules on digital payments.
Okay, what was the market impact?
Well, you saw the vulnerable sectors get hit. Tech, like PayGM, reportedly crashed, losing around 500 euros a share, wasn't it? Hit by both higher borrowing costs and those new compliance rules.
Double whammy.
Yeah. And real estate, like DLF, slumped because higher mortgage rates just put buyers off. Sales slowed right down.
And the defensive ones did okay.
Exactly. Consumer staples, like HUL, held relatively steady. People kept buying their everyday stuff.
Right, the OBR products.
And banks, like HDFC, actually benefited initially from those higher interest margins as rates climbed. It just shows that divergence really clearly.
This is super helpful, especially for our listener, the novice trader you mentioned.
Yeah.
What are the key practical tips or takeaways from this material for someone starting out?
There are a few really actionable points. First, track policy announcements. Know when the big ones happen.
Like the union budget in Feb.
Yep. And the RBI meetings, roughly every 6 to 8 weeks, put those on your calendar. That's when changes are most likely announced.
And it's not just what they announce, but how it compares to what people expected.
Exactly. That's the second tip. Check market expectations. The market often prices in what it thinks will happen. The big reaction comes from the surprise.
So if everyone expects a small rate hike, but they do a big one,
that's when you see a sharper market move, often downwards in that case. Surprises matter.
Okay, third tip.
Diversify. This is crucial given how differently sectors react. Don't load up only on interest rate sensitive stocks, for example.
Mix it up, some cyclical, some defensive.
Right. Blend stocks that do well in good times but are policy sensitive with those stable defensive ones. It helps manage that policy risk across your portfolio.
Makes sense. And the last one.
Stay informed. Sounds basic, but just keep reading reliable financial news. Follow what's being discussed about potential policy shifts before they happen. It helps you anticipate.
This really clarifies things. You're right. Thinking about government and RBI policies as the economic weather makes a lot of sense.
Yeah, some policies bring sunshine for certain sectors, others bring storms.
And who gets soaked really depends on their business model. Different sectors definitely feel it differently.
And what really stands out is how much those surprises can jolt the market, isn't it?
Yeah, definitely.
Which leads to a final thought, maybe something for you, the listener, to mull over based on all this. If policy surprises can have such a big immediate impact, what does that really tell us about how hard it is to consistently predict market movements? And how important is it then to not just track current policies, but to also think about potential future policy changes or shifts in what the government or RBI might prioritize next?